Hey everyone, Dan here. We are just in the beginning of Power Hour on Tuesday, May 11th, and today we're going to take a look at some stocks that you can play when the market is going down, specifically certain areas or sectors of the market, and these ETFs will increase in price when those sectors or those areas of the market are selling off. Before we get into it, if you enjoy these videos, please hit the like and subscribe button. It helps a lot. And let's jump right in. So we're not going to do any charting today. We're not going to look at indicators. There's hundreds of videos at this point that I've put out that deal with charting. I'm sure we'll return back to it tomorrow. But just based on sort of a bunch of the hits that folks have been taking since February, say something like that. The growth stock sector has been getting hit pretty hard. Obviously, the tech sector has been selling off. The NASDAQ has sold off more than the S&P and the Dow, I believe. I didn't calculate that, but it sure seems like that's the case. And so today I wanted to focus specifically on ETFs, inverse ETFs that go up when sort of growth sector and tech sectors sell off. And you sort of have to do some approximations with these things because in my previous video, which I will link above if you want to look at that, there are some very specific inverse ETFs like SQQQ, SDOW, and there's several others that specifically interact with the NASDAQ and the Dow and the S&P. The ones that we're going to deal with today can be a little bit harder to get at exactly what accounts for a growth stock and sort of emerging markets and things like that. And so we're going to try to target those since I know a lot of folks that watch these videos often are playing growth stocks like Palantir, certain emerging markets like Jumia. And so, I thought that it would maybe help some folks who've been getting hit extra hard lately sort of recover their accounts on days like today. One huge thing that I will preface this entire video with is these leveraged inverse ETFs are not meant to be held for the long term. These are typically meant to hold intraday. So you will potentially have to use a day trade in order to participate in this, but again, these are sort of it's sort of pulling the emergency brake when the sector that you are most invested in starts to sell off. When I woke up this morning, I looked at the pre-market and there was several growth stocks that were 4, 6, 10% down pre-market. So on days like that, when you think, holy smokes, some challenging times are coming today and maybe in the days ahead, that's the time that you want to sort of brush the dust off of these tickers and sort of reintroduce yourself to them and see which ones might sort of offset some of the tickers that you're playing as sort of a hedge maybe, or if you want to just exit the positions that you have that are sort of systemically getting beaten down and move into some of these periodically in order to keep your overall account from suffering too much during lengthy periods of selling off, then that's sort of the idea behind these tickers. I hope that makes sense. If it doesn't, just say so in the comments and I'll try again to explain it. I'm also very, very tired today because I have young children and they keep you busy. So the first one that we're going to look at is TZA. And so for each of these, since we're not going to do the charting or anything like that, I just put a couple of blocks of text in them to sort of explain what they are and when you might use them. So if you're not familiar with the Russell, let's start here. If you're not familiar with the Russell 2000, you could Google any of these and do your own due diligence. You should do that anyway. If something piques your interest here that you're not familiar with, go do your own research and intermix what you learn with sort of what's been said here, or use this as sort of just a springboard or a jumping off point to learn more. But the Russell 2000 is focused on these smaller cap stocks. And so the interesting thing in terms of like the growth companies or the growth sector that we talked about before that's been getting hit tremendously hard. Basically when the tech sell-off started, I think it was February, but ever since then, tech has had a hard time sort of like systematically recovering, and growth stocks have just continued to get a lot of pushback and a lot of selling pressure. So the interesting thing here, June 29th, 2020, the changes that were initiated by the Russell 2000, by the folks who manage that, they're moving toward larger companies over small, which is much different than their focus has been previously. But the important thing here is growth companies over value companies. So that's what we want to see. So growth companies, so think of like your Palantirs over your Walmarts, for example, and tech and healthcare over other sectors. So again, obviously, like tech has had a lot of punishment lately, and but nothing more so than the growth stocks. So that's why I thought this one might be interesting to folks. But you should go dig back through the history, get really deep into how the fund operates, and even if you are just holding it intraday, these leveraged funds, because they return minus 3x the daily inverse exposure, they can move really, really fast. So you have to be careful with them because they will move sort of at 3x the speed of the ETF that it's tracking, that it is producing the inverse exposure to. So, this is one that you could think about for sort of like offsetting some of your growth stocks, hedging against losses that you're taking on days when it turns red. But again, remember, don't hold these long term, or even a lot of folks would recommend don't hold these overnight, because the way in which they're structured, they tend to decay over time anyway. And the U.S. stock market has shown like consistent growth decade over decade over decade. So of course, this being the inverse is going to decrease in value as the time goes on. So TZA is one that I think is probably worth looking at if you are overexposed in growth companies, or you notice that there is big growth sector selling off happening and you want to profit from it. This is a way to do it. You just buy shares of TZA. TWM is the next one. And again, the idea here is just you would buy shares of TWM. Right now it's at 1478. You'll see these charts get progressively worse because again, you probably wouldn't come in and actually chart this like we do other charts. You would more so notice that something is happening in the sector that this is the inverse of, and then act on it based on that. You could do a little bit with the indicators and such, but you would probably notice something happening because of the inverse, because of like the Russell 2000 dropping, for example. But TWM provides a one-day 2x inverse bet. So instead of the 3x, this is going to move 2x. So it's going to move slightly slower. So it could feel a little bit more controlled for some folks. But the idea here is sort of like if the Russell drops 1%, this would go up 2%. So that's kind of the idea. And with TZA, the Russell drops 1%. TZA would theoretically go up 3%. All of this sort of depends on the intricacies of everything that's happening and exactly how the fund is managing itself and how well it's executing on any given day. But the good ones are like spooky how close they are to hitting that inverse 1, 2, or 3x that they strive for. So inverse bet against the Russell 2000, nothing like super different from TZA other than the 2x versus the 3x. And, it's sort of like points out here, primarily focuses on small cap segment, might include some mid caps and some micro caps as well. So again, do your research, look up if you're unsure of like sort of what some of this jargon is, just go do some research and it'll be more fruitful for you to like dig into these things that are interesting to you and unpack them for yourself than for me to sort of like quadruple the length of this video by sort of defining every single term. So this is what I was talking about with the charts getting progressively uglier. Like there is just no way to chart this thing that we're looking at right now. But the important thing to note is, right now this is HDGE. So to me, it reads like hedge. It's a combination of quantitative and fundamental factors to build a portfolio of short interest in large and mid-cap U.S. listed securities. So here's one, focus on U.S. companies. And, I would just sort of like keep this. I keep these that we're talking about now and the ones that I did previously about the market crashing and what to trade when the market crashes. I keep these on a watch list called bear, just so that when I know a lot of red, if we're swimming in a sea of red or if some particular sector is getting hit extra hard, I'll kind of go to my bear watch list and I'll say, okay, things are turning bearish in the market or things are turning bearish in this sector. Is there an inverse ETF for that? And if so, is it leveraged? Is it not? Are there several options, some leveraged, some not? But this gives you another opportunity. But just like I said, look into these, see exactly what it is that you are sort of buying into in terms of what it inverses, and that will help sort of like lead you to the right mix or the right plays on any given day. And remember, I know it's annoying, I keep saying this, but don't hold these long term. That is not what you want to do. I cut it off. I didn't copy that part of the description, but I think all of these in their description ended with like, because of the way this fund is managed and how we sort of like provide you this inverse relationship. These are not meant to be held long term. It even says that like in the description. So if you look them up for yourself, you'll see that as well. EUM is just a 1x, a minus 1x offering. And so this one will move at the same speed. So idea here being if MSCI, which is the Emerging Markets Index, goes down 1%, EUM should go up about 1%. So it won't move quite as quickly. But these are ones that we're talking about. I talk about like TSM a lot. I talk about Jumia. What have we talked about? Ozone before? The Russian Amazon. And I don't know particularly if any of those tickers are being inversed in this ETF, but the idea there being that like emerging markets is the focus for this one. So if you are either really leveraged on emerging markets and you're getting hammered on any given day, this might be a way to sort of like offset. Or if you just notice that there's huge selling pressure on any given day in emerging markets, you might sort of like take a glance at EUM and say like, is EUM kind of flying right now? And if so, it might be an opportunity to, for a day trade or so to jump in. And the last one, GNAF. So this one is a little bit different, but it's like obviously tech focused. It's focused on Facebook, Apple, Amazon, Netflix, Google. So the FANG companies and other companies that exhibit similar characteristics. So like that's always sort of like the special sauce, essentially, the sort of like proprietary information, like how they make that determination. But the idea here, it doesn't say for sure that GNAF always holds these 5 companies, but it says presumably the index will always include these 5 companies. So most likely, but you never know. And then other like similar stocks or companies that seem to fit a similar criteria, including consumer discretionary sectors. So again, if like you are reading the news or see something come up and like that sector is getting hit very, very hard, might be worth a look at GNAF to see, if this one is increasing as that sector is getting hit pretty hard. And again, ugliest chart that you could ever hope for. So not something that we're going to be charting, but just again, to know that here's where you could hop over to if you don't want to sort of just sit on the sidelines during red days. But you have to sort of figure out what it is that you want to do with red days. Some folks want to sort of use it to average down. Some folks want to use it to sit on the sidelines and wait for floors to establish in some of their favorite stocks and get them at what they think could be a good deal. That catching a falling knife strategy is always challenging, but you're never going to hit it 100%. But if you can get a pretty good win rate going on that, or catch most of the move most of the time, then that's sort of like a good thing that you're going to hope for in the long run, or not hope for, but work toward. So hopefully these 5 tickers give you something that you can sort of like, again, stick on a watch list and just sort of like have it in your back pocket. And just when you see a sea of red, or when you hear that there's incredibly high selling pressure coming into a certain sector, tech, growth, emerging markets, FANG, whatever it may be, these give you some places to turn to say, I wonder if I could sort of like get some green into my portfolio by day trading one of these inverse ETFs. Okay, well, that will do it for today. Tomorrow, barring something unforeseen, we'll get back to our typical kind of like, let's look at this ticker for the day and chart it out and look at the indicators and see what they're telling us. But it's just been a wild few months, and sort of like in some ways seems to be picking up steam, but I just think that like it's wearing on folks who thought that they were buying and averaging down, buying the dip in February and March, and then they've just sort of like been trying to hang on throughout April and May, and just kind of feel like they don't have any money left to continue to average down, and then start to question like, are these stocks going to come back? So I wanted to at least give folks who are of the mindset to do so, give them an opportunity for an alternative if those strategies that I just described are no longer working for them. Here's something else that you can at least look into and consider. All right, well, I hope everyone is doing all right so far this week, and I will see you in the next video.